Well, before we get into the new proposals, I just want to get somewhat of a picture of the current situation in terms of loan defaults in Kenya.
Thank you very much for hosting me on this program. What I can say is that since the introduction of credit reference bureaus 2 years ago, there has been a drastic fall in the non-performing loans within the banking sector. I think that most of the defaulters who were serial defaulters and those who had defaulted on small loans have had to pay up whatever they had, and the rate of customers who are defaulting has actually gone down because of the sharing of credit information amongst the banks.
So now, what does this new proposal by the banks mean for the whole industry?
Basically what it means is that when the first law was passed to allow the banks to share information, it mandated banks to share only negative information. This new law has gone a step further and now mandates banks to share positive information, which means that the customers with good credit histories will now have a chance to use their credit history to access credit from banks at lower rates and more favorable terms, as opposed to only customers who had default histories appearing in the credit bureau files.
So the new regulation are still up for public debate. Do you see any of these regulations are going through, or is the public going to be happy with such regulations coming through?
Yeah, it's still in the draft form. It has to be debated among the stakeholders. But the important thing to emphasize is that it is an opportunity for the good customers to be able to use the credit bureaus to access credit from the banks. Currently, the good customers who have good credit histories have not been able to use that history to access credit from banks. The other factor that we have seen is that interest rates have remained high simply because the credit bureaus have been focusing on sharing information on non-performing loans. And therefore, if the issues come out properly, I think that the general public plus the lending community should see this as a boost in the business of lending, as it were.
Do you see the use of perhaps guarantors falling back when this new proposal comes through?
Maybe not, because within the lending institutions, quite a number of borrowers have used guarantors to borrow. And what has happened is that when a principal debtor defaults, usually the guarantor is called upon to pay. But in fact, even in the sharing of negative information, guarantor information has always been provided to the credit reference bureaus. But what the law has done is now to bring this to the fore, to be able to say that if you are a guarantor and the principal debtor defaults, you will be taken through a period. You will receive a 30 days notice to tell you that the principal debtor has defaulted, and then you will have 60 days within which you should make good the amount that has been defaulted. If you do not do that, then you will be listed in the credit bureau capacity, in your individual capacity as a defaulter.
So the information.
And therefore, what will happen is that guarantors will now become more careful to be able to consider and understand what they are getting into before they give a guarantee to any potential borrower.
So that's likely to affect banks going forward in terms of loans being given to the public. So the impact for banks when this new rule comes through?
Yes, that is likely to happen, but not so much, because again, what we're looking at is that from a consumer borrowing point of view, customers with good credit histories may not require guarantors to be able to support them in their borrowing. The good credit history that they have, which is now coming to the credit bureau, should be able to support their access to credit. In the sense of companies that borrow, usually what banks will do is that banks will always take directors' personal guarantees. So that practice will not stop. What will then happen is that the directors will then know that they will be listed in their individual capacities when the principal debtors do not make good the liabilities they have created.